Hey there, fellow investors. Today, we're diving into the exciting world of dividend investing. It's a strategy that's close to my heart, and for a good reason. It's all about building a portfolio of stocks that pay you, the shareholder, a regular stream of income. Think of it as getting paid to own a piece of a company. Now, you might be thinking, isn't that what all stocks do? Well, not quite. You see, when you buy a stock, you're essentially buying a tiny slice of ownership in a company. Some companies choose to share their profits with shareholders in the form of dividends. These dividends are typically paid out quarterly, like clockwork. Dividend investing is a popular choice for both seasoned investors and those just starting their investment journey. Why? Because it offers a way to generate passive income and potentially grow your wealth over the long term. And who doesn't love a little extra cash flow, right? Whether you're saving for retirement, a down payment on a house, or just want to supplement your income, dividend investing could be the key to unlocking your financial goals. So, buckle up, and let's explore the ins and outs of this powerful investment strategy together. All right, let's break down some key metrics that every dividend investor needs to understand. Think of these as your trusty tools for evaluating dividend stocks. First up is dividend yield. This tells you how much income you'll receive for every dollar you invest. It's calculated by dividing the annual dividend payment by the stock's current price. For example, a stock trading at $100 per share that pays a $4 annual dividend has a yield of 4%. Next, we have the payout ratio, which is like a financial health check for a company's dividend. It shows the percentage of earnings that are paid out as dividends. A lower payout ratio, ideally below 60%, suggests that the company has room to maintain or even increase its dividend in the future. Last but not least, we have the dividend growth rate. This metric tracks how much a company has increased its dividend over time. A history of consistent dividend growth is a good sign that the company is committed to rewarding its shareholders. Remember, folks, understanding these metrics is crucial for making informed dividend investment decisions. Don't just chase the highest yield. Look for companies with sustainable payout ratios and a solid track record of dividend growth. Now, let's talk about the creme de la creme of the dividend world, dividend aristocrats. These companies are like the royalty of the stock market, having increased their dividends for at least 25 consecutive years. Talk about commitment. Investing in dividend aristocrats is like joining an exclusive club of companies with a proven track record of profitability and shareholder-friendly management. These companies have weathered economic storms, recessions, and market downturns, all while continuing to reward their investors with rising dividends. Think of companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. These household names have been paying and increasing dividends for decades. They're the epitome of stability and resilience. While past performance is never a guarantee of future results, dividend aristocrats offer a sense of security and reliability that's hard to find elsewhere in the stock market. They're a testament to the power of long-term compounding and a testament to the benefits of finding companies with enduring competitive advantages. Now, I know what you're thinking. This all sounds great, but I don't have time to research individual stocks. Well, fear not, my friends, because exchange-traded funds, or ETFs, are here to save the day. High-yield ETFs are like baskets of dividend-paying stocks, all bundled up into one convenient investment. They offer instant diversification, which means you're spreading your risk across multiple companies and sectors. One of the biggest advantages of ETFs is their low fees. Since they're passively managed, meaning they track a specific index or sector, you don't have to pay a high-priced fund manager to pick stocks for you. This keeps more money in your pocket where it belongs. There are tons of high-yield ETFs out there, each with its own investment strategy and focus. Some target specific sectors like real estate or utilities, while others track broad market indices. The key is to do your research and find an ETF that aligns with your investment goals and risk tolerance. Section 5. The $1,000 per month blueprint. Nasdaq-100 High Income ETF in action. Let's bring this all together with a real-world example. Imagine you have $107,000 to invest, and you're looking to generate $1,000 per month in passive income. That's a 12% annualized return, which is a lofty goal. But let's explore how it might be achievable with the Nasdaq-100 High Income ETF, or QYLD. QYLD, managed by Global X, is designed to deliver monthly distributions of income through a covered call strategy on the Nasdaq-100 index. While its past performance is impressive, it's crucial to remember that past results are not indicative of future returns. As of today, May 6, 2025, QYLD boasts a juicy 13.16% annual dividend yield. Now, if you were to invest that $107,000 in QYLD, you'd be looking at approximately $1,107 in monthly dividend income. Keep in mind, though, that dividend yields can fluctuate, and there are no guarantees in the stock market. However, this example illustrates the potential income-generating power of high-yield ETFs like QYLD. Section 6. Dividends versus growth stocks, a tale of two strategies. Now, you might be wondering, Jim, why choose dividend stocks over growth stocks? Well, it all comes down to your investment goals and risk appetite. Growth stocks are like the Ferraris of the market. They're fast-paced and exciting with the potential for explosive returns. Think tech darlings and innovative disruptors. But with high potential reward comes higher risk. Dividend stocks, on the other hand, are more like the reliable SUVs of the investing world. They offer stability, income, and the potential for steady growth over time. They might not experience the same meteoric rises as growth stocks, but they can provide a smoother ride, especially during market turbulence. The beauty is, you don't have to choose just one. A well-diversified portfolio often includes a mix of both growth and dividend stocks, providing a balance of risk and reward. Section 7. Navigating the risks, dividend cuts, and market volatility. Now let's not sugarcoat things. Dividend investing isn't without its risks. Just like any investment, there are potential downsides to be aware of. One of the biggest risks is dividend cuts. Companies can reduce or even eliminate their dividends, especially during economic downturns or if their financial performance takes a hit. This can be a real blow to your income stream. Another risk is market volatility. Dividend stocks, like all stocks, can be affected by market swings and downturns. While they tend to be less volatile than growth stocks, their prices can still fluctuate, and you could lose money, especially in the short term. The key to mitigating these risks is thorough research and diversification. Don't put all your eggs in one basket, or in this case, one dividend stock. Spread your investments across different companies, sectors, and even asset classes to reduce your overall risk. Section 8. Building your dividend portfolio, a step-by-step guide. Ready to start building your own dividend powerhouse? Here's a step-by-step guide to get you started. 1. Define your goals. What are you hoping to achieve with dividend investing? Retirement income, supplementing your current income. Having clear goals will guide your investment choices. 2. Determine your risk tolerance. How much volatility are you comfortable with? Are you willing to ride out market ups and downs, or do you prefer a more conservative approach? 3. Choose your investments. Research and select dividend-paying stocks or ETFs that align with your goals and risk tolerance. Look for companies with a history of dividend growth and sustainable payout ratios. 4. Diversify your portfolio. Don't put all your eggs in one basket. Invest in a mix of companies, sectors, and asset classes to reduce your overall risk. 5. Monitor and adjust. Regularly review your portfolio's performance and make adjustments as needed. Rebalance your holdings, reinvest your dividends, and stay informed about market trends. Section 9. The power of compounding. Turning dividends into a wealth engine. One of the most compelling aspects of dividend investing is the power of compounding. When you reinvest your dividends, you're essentially buying more shares of stock, which generates even more dividends. It's a virtuous cycle of growth. Think of it like a snowball rolling downhill. As it gathers more snow, it gets bigger and bigger, gaining momentum along the way. Compounding works the same way with your investments. Over time, even small amounts of money can grow exponentially through the magic of compound interest. Dividend investing, with its focus on generating regular income and reinvesting those dividends, puts the power of compounding to work for you. It's a long-term game, but the potential rewards are well worth the patience and discipline. So, there you have it, folks. Dividend investing is a powerful strategy for generating passive income, building wealth, and achieving your financial goals. Remember to do your research, diversify your portfolio, and stay focused on the long term. Happy investing!